How can startups and small businesses successfully raise capital online? This is what we're going to see in this video. I'm Léa Bouhelier-Gautreau, and this video is presented by KingsCrowd. KingsCrowd is a platform aggregating, rating, and analyzing every single equity and debt crowdfunding deals available on crowdfunding platforms. KingsCrowd also provides market data and funder profiles to investors to help them make informed decisions. KingsCrowd also has its own venture capital fund that invests into the top equity crowdfunding deals. And finally, like today, KingsCrowd provides resources for funders to help them successfully raise online. We, for example, have a founder valuation tool that helps founders find not only the right valuation for the company based on market data, but also estimate the amount that they could raise through crowdfunding. KingsCrowd also partners with Raise Papers to help founders file their Form C offering statement and other legal documents related to Reg CF and Reg A raises at a lower cost than any lawyer. So let's get started. How can founders raise money in an online route in only 10 steps? Well, the first step for any founder is going to be to ask yourself the right questions. First, why are you trying to raise money online? Is it because you want your company to grow? Because you're trying to survive through difficult economical times? Or is it because you're trying to launch a new product? Any of these aspects are going to change the way that you're going to present your pitch and your company to investors. Are you maybe trying to use equity crowdfunding or debt crowdfunding as a marketing tool? Do you want to get investors that are going to become engaged customers in the future? Do you want to raise awareness about your product online? Maybe you even want to gather a community. Once you know your why, you need to know how much you want to raise. You will need to figure out both your minimum goal and your maximum goal, meaning what is the minimum amount of money that you need to raise to reach your goal, whether it is to grow, to survive, or launch a new product in your company. And what will be the maximum goal, maximum amount of money that you will be willing to raise online? This maximum is very important because it will determine either the amount of debt that you will have to reimburse or the amount of equity that you will give up to investors. And this can also impact the return that you will have in the future. Therefore, finding the balance is very important. Once you have answered these two questions, you can move to step 2, finding the right security. Some of you already may know, I don't want to give up equity. So you may want to raise debt. Some of you may not want to have to touch to their revenue streams, to their cash flow for the next couple of years to reimburse investors. Therefore, you may want to raise equity. But if you're not sure, or if you want to verify whether you made the right assumptions, ask yourself these couple questions. First, is your business quickly scalable? Second, will you ever want to exit? Well, if you answer no to any of these questions, you will have to raise either through debt or a revenue share note. What are these two terms meaning? Well, a debt raise is simply a loan that investors will give you, like you will get a loan at a bank. You will have to reimburse investors over a certain amount of months, usually totaling 4-5 years, and you will reimburse them not only the principal, but also the interest. The interest rates as of November 2023 vary between 5% and 14% on debt crowdfunding platforms. However, most deals are offering interest around 10 to 12%. A revenue share note is slightly different than a regular loan. It is a type of debt that you will have to reimburse. However, you will only reimburse this debt once you have revenue flow. Of course, by the end of the debt term, if you did not reimburse the entirety of your debt, you will be entitled to finishing the reimbursement to your investors. However, let's take a guess. You're building a new bakery. This bakery will only be finished 1 year from now, but you already need to raise the money. Well, with a revenue share note, you will not have to reimburse anything until you actually start generating revenue. So how much will you have to give back to investors? Well, revenue share notes come with what we call a multiple. You will have to reimburse 1 point something or 2x of the amount of money that you borrowed from investors. For example, right now on debt crowdfunding platforms, the typical revenue multiple is going to be between 1.2x and 2x, meaning if I raise $100,000 at a 1.5x multiple, I will need to give investors back $150,000. Usually, as of November 2023, the multiples on the crowdfunding platforms are around 1.5 to 1.7x. All right, what if you answer yes to both of the previous questions that we asked ourselves? Well, in that case, you will qualify to raise through equity. And you have 3 ways of raising through equity online. First, you can raise through a SAFE. A SAFE will allow you to not actually issue equity and shares right now, but it's a promise that you make to investors that in your next or any of following equity run, you will issue these investor shares and they will finally become shareholders. You usually want to raise a SAFE with a valuation cap and a discount rate. What does that mean? If you raise right now, today, with a 10 million valuation cap, and in 2 years you issue equity at a 20 million valuation, while investors that took the risk to invest in you today will receive equity as a 10 million valuation cap. If you raise with a discount raise, let's say a 20% discount raise, and you raise today with a 20% discount raise, and in 2 years, you raise equity, you issue equity at a 10 million valuation. Investors that took the risk to invest in you today will get a 20% discount on that 10 million valuation, meaning they will get shares at an 8 million valuations. It's usually important to put a valuation cap. Investors also appreciate when there's a discount. The reason for putting a cap is that it reassures them that the valuation of the company will not be higher than this valuation cap, and therefore they feel like they're taking less risk when it comes to the price of your company. Right. You can also raise future equities through a convertible note. A convertible note is very similar to a SAFE, but it has interest that accrue through in between the moment of your raise and the moment where you will actually issue equity. And this interest will be transformed into shares for investors. Finally, you can already issue shares right now and decide to raise through equity, whether it will be equity common or equity preferred. Usually, investors tend to prefer equity preferred because it gives them priority over other investors and over, most importantly, common shareholders to get returns at the moment of exit or liquidation. Therefore, it kind of lowers the risk of the investment. All right. Now that you found the right security, you can move to step 3. Step 3 is actually figuring out, can you reach your goal? And to do that, let's look at the data. First, what are the crowdfunding trades for equity crowdfunding deals? Well, all industry merge. Right now, as of November 2023, the median equity amount raised is slightly above $100,000. Note that this median amount varies usually between $100,000 and $130,000, depending on the state of the market, the time of the year, and outliers that will be overperforming on the equity crowdfunding market. To give you an idea, about 10% of the startups raising through equity reach $1 million raised, 20% reach $500,000, and 30% reach about $300,000. This is important for you to know, so you can figure out, well, if I want to raise $100,000, I have more or less 50% chance of raising my goal. What if I want to raise $1 million? I have more or less 10% chance of reaching my goal. However, as we're going to see later, there's a couple of things that you can show investors that are going to increase your chances of actually reaching higher number. So stay on the video, we'll mention that later. But first, let's take a look at the median debt amount raised. As of November 2023, the median amount raised is $41,000, with 5% of the companies reaching $500,000 raised and 25% reaching $100,000 raised. Same thing here. If you think of raising through debt, this gives you a benchmark and helps you picture how much can you realistically raise online. Know that these numbers are going to vary industry by industry and depending on your business type. What is your revenue right now? What industry are you operating in? Are you a B2B, a B2C company? Well, if you want to actually compare your company with similar companies, you can simply go on one of these two links. Either kingscrowd.com/company/search is going to give you a table where you can filter based on several criteria, and you will access on the chart the different amount raised by companies based on the criteria that you will select. You can do the same thing on kingscrowd.com/explore, which will give you a different user experience that will be not showing you a chart, but focusing on deal by deal. And after looking at other companies, how much other company raised, well, it's kind of time to ask yourself the question, is your company exciting? Because this is going to play a big role in the amount of money that you will be able to raise from total strangers. Let's take a look at what I mean by an exciting company. Well, let's try to ask yourself, is your product unique, new? Can it really trigger investors' curiosity and fill a need in the market? Is your company having a strong traction? Meaning, for example, a lot of revenue, great partnerships? Do you have a team with previous startup experience, for example, exits? Or is the industry backing you? Did you already raise money for the venture capital investors? Do you have famous founders from other companies that are backing you? All of these things are going to increase the social proof and also the idea for investors that your deal might be the right one, or at least that it is better than the other deals that are currently offered. Once you have figured out how much you can actually raise online, step 4 is going to be to choose the right platform. And to do that, you have to look at platforms' features to make sure that the platforms can be a right fit for you. First, you will have to look at the platform's traction, meaning how many investors are actually investing on this platform? How much money can the companies raise on these different platforms? Does that fit your goal? And what is the overall volume of investment that goes through each platform? Well, this is what we're going to take a look at right now. On this chart, you can take a look at the amount of money that was invested on each platform since 2022 for equity crowdfunding raises. And what we can see here is that WeFounder had the biggest amount of investment through its platform since 2022 for all the raises that started raising in 2022 with 26.4%. Dalmore Group, which is mostly hosting Reg A raises, also got about 21.5% of all the investments being made through its platform. And Start Engine is following with 18.6%. You can see right here that Republic has 13.7%. And Dealmaker Securities, 7.7%. Dealmaker Securities is an interesting platform because we've seen that the amount per raise on Dealmaker Security is on average 10 times higher than amounts raised on WeFounder and Start Engine. So while these platforms have high volume of raise, this platform and Republic as well a little bit have, I want to say, higher amount raised per deal. Now let's take a look at what is happening on the debt size. Well, on the debt crowdfunding investments, you can see that the market is well more shattered, well more crowded. There are a couple leaders, companies that are really performing better, like for example, Dalmore Group one more time, or we have Mainvest at 14%, WeFounder at 11%, SMBX, Republic. But as you can see, a lot of platforms are actually around 10 to 20% of market shares. So it's going to be up to you to choose what is the right platform for you. And same thing, you can look on KingsCrowd.com to try to look at what are the companies that have been raising on this platform, how are they performing, and what are the industries. Then once you have looked at the platform traction, you will want to look at the platform specificities. Companies, for example, like Start Engine, mostly feature equity deals, and they don't really, Start Engine doesn't feature safe or convertible note deals. Republic only features highly vetted deals. So not every company can raise on Republic. They have to go through a due diligence process at first. You're going to have other debt platforms that are going to host more revenue share raises, while other platforms that are going to share more debt loans. It's going to be up to you to see what can fit your company profile the most. Once you have looked at that, you will want to look at the platform fees. What does that mean? Well, as you will raise funds online, the platforms are going to take a percentage of the amount that you raise for themselves to pay themselves. Some of them even may take equity from your company. And some platforms will ask investors to pay an extra fee when they make the payment to invest into your company. You will want to look at all of these fees and make sure that you find a deal that is right for you. Last but not least, do not hesitate to talk to different platforms and negotiate. Now that you've chosen the right platform, you will have to prepare your legal documents. And there are quite a lot of legal documents. First, you will have to make sure that you're a US-based legal entity. For most of you, it may be the case, but if your company is still at a very early stage, you will have to get this done. You may also have to set up a cap table based on the type of security that you're selling. You may have to authorize shares, and you also may have to start a subscription agreement. Finally, the most important point is going to be to set up an offering statement and set up your financials. Make sure that they are correct and will be accepted by the SEC. How can you actually get this done? Well, in some cases, the crowdfunding portal that you will choose, the platform, will actually do that for you or will help you. In other cases, you may have to do that on your own. And you have two choices to do that on your own. The first one is to use a lawyer. The second is to use race papers. Race papers will allow you to get most of these documents set up, or at least help you for half of the cost of a lawyer. As you prepare your legal documents, you will have to choose between raising through a Reg CF or a Reg A. The main difference being that with a Reg CF, you can raise up to $5 million, and with a Reg A, you can raise up to $75 million. Of course, the time and amount of money that you have to spend to set up these two different regulations are different. In the case of the Reg CF, if you use race paper, you can spend as a minimum of $3,500 to set up all your legal documents. While if you use a lawyer, you can spend up to $20,000. On the Reg S side, if you use race papers, you can set up all of your documents for as low as $50,000, but it can go up to $250,000. And right now, I'm not even talking about the money that you could be spending on marketing. The amount of time that you will also spend preparing this document will differ. For Reg CF, you will have to spend up to 4 to 10 weeks to set up your legal documents. While for Reg A, it can take as little as 6 months and as high as 15 months for you to prepare these documents. Therefore, you want to make sure that you have enough runway to go through preparing these documents when you actually start considering raising through a Reg CF or a Reg A. As you will have done with your legal document, you will also have to find the right valuation. Some of you may only find the right valuation as this step of the process. Some of you will want to do it earlier. And if you're raising through a debt note, you will not have to find the right valuation. So this step can kind of move in time, and it's up to you to find the right time. But there are two ways for me to give you an idea of what is the right valuation for your company. First, we can look at the median valuation of startups by revenue stage since April 2022. As you can see, startups that are pre-revenue are valued, at least for 50% of them, at $14 million or more. Startups that are post-revenue, between 0 and 1 million in revenue, will tend to have valuations around $10 million. And as the revenue of this startup grow, the valuation will grow as well. But if you want to find out which valuation is the right one for your company, you will want to go on KingsCrowd's valuation tool. KingsCrowd.com startup valuation tool, you will be able to enter a couple data points about your company, and our system will help you find the right valuation for your company. Once the legal documents are done, the valuation is found, well, then the fun part can actually start. You will need to prepare your pitch. Preparing your pitch may be one of the most important points of your raise. You will want to make sure that the deal is actually exciting for investors, that you make sense, and that investors can quickly understand your value proposition. The first step is to actually set up a good story. What does it mean? A story, for example, can show you sense of mission. And I like taking the example of Recompose. Recompose is a company that was close to $2 million online. And the founder of Recompose had a deep sense of mission to make human composting as a funeral service available in the United States. She actually lobbied with a lot of state representatives to make this funeral service legal in 6 states. And I do believe that her sense of mission helped her raise close to $2 million. You can also have a brand new innovation, like TimePlast, that raised $5 million on Start Engine. If you have a brand new innovation, something that is mind-blowing, you want to make sure that investors will understand that. Finally, if you don't have a deep sense of mission as something that really can raise the crowd with you, if you don't have really an innovation that is groundbreaking, well, use your creativity to make sure that investors will remember you. You can take the example of Veer. Veer had a very particular and funny video. I'm not sure whether this is the right thing to do, but what I can tell you is that I still remember it. So it must have worked in some way. Step 2, to preparing your pitch, you will want to make sure that you have the right format. Use pictures, use videos, and short paragraph. As you know, a lot of people, me included, being online can have limited attention span. You want to make sure that people would just not get bored by looking at your pitch and will actually get excited. Don't hesitate to highlight the keywords, put them in bold, underline them to make sure that investors will catch the most important points about your company. You will want to make sure that you have the right content. What does that mean? You want to make sure that the problem is well understood by investors. Remember, some of them are strangers. They may not know anything about you, neither your company, neither your problem. What if they're not your typical customer? Well, not only you want them to understand what is the pain point that you're solving, but how your product is a must-have. How is it better than competition and alternatives? You also will want to present your team and make sure that investors will understand that your team is the right one to solve this problem. Remember, you're probably not going to get on a call with every single investor that is going to back you in your raise. Therefore, it is your raise page and your pitch that will convey this information to them. Another point that is very important is sharing your growth strategy. And this is something that is often missing in a credit crowdfunding round and sometimes in debt crowdfunding rounds as well. Investors are going to invest in you. They want you to either reimburse the loan or they'll get a return on the equity that they will have in a couple of years as you exit. Well, you want to make sure that your company is going to grow enough that you can have the financial backing to either reimburse the debt or get acquired, go through an IPO, or give them a great return on their shares. As you prepare your content, please use numbers. Remember, most investors are going to be strangers. They do not know you. They do not know your company. So the only thing that can actually prove that you can deliver and that your company is exciting are the numbers. Share as many numbers as you can with investors. And the last step is going to get feedback on your pitch. Talk with people that are going to give you honest feedback and can tell you what can be improved. Listen to the question that they have. It might be something that you need to add to your pitch. And you will also need to think about whether you want to hire a marketing agency or not. This will be up to you, but make sure to compare different agencies and talk to founders that previously used them to see whether these agencies were actually successful in bringing funds to the type of company that are like you. Step 8, you will have to launch your raise, and very important, you will need to get early traction. Let's look at the data. The data actually shows you in purple that the biggest amount of money in your raise actually comes in the first 14 days of your deal. For companies that raised at the end of their raise less than $130,000, 95% of the amount raised came in the first 14 days for at least half of the companies. For companies raising 1.3 million or less, so remember, about 10% of the deals that are here online, 66.2% of the amount raised came in the first 14 days for at least half of the companies. And finally, for even companies that raise way more than $1.3 million, half of the amount that they raise came in the first 14 days for at least half of these companies. Therefore, make sure that you get an early traction. To do that, you will need to bring your community, your friends, and your family to invest. And if you worry whether you can convince them, well, if people that know you and know your business cannot invest early on, this is going to give a terrible signal to investors. Make sure that they understand the risk that they are taking, that they are willing to lose all of their money by investing into your company. But it is very important that the people that already know you start backing you at the beginning of a crowdfunding race. Next, once you have early traction, you can go to step 9, being actually execute on your strategy. What does that mean? You will need to share regular updates with investors. Do not hesitate to get product launch happening during your race to get investors excited about your company. You can also use third-party references. Companies like Alts.com or KingsCrowd can provide paid or free references to try to bring more investors into your race. You will also need to talk with investors, especially the investors that can write the largest checks. Maybe for 10 investors that we talk to, only one will invest. But that's okay, because it will increase the amount of money that you will raise on your platform. It is time well spent, as it will be a social proof for other investors and will more likely make them follow other high influential investors on your raise. You will want to also get a strong close. I know that the data that we show later show that most investors really invest early into a raise, but some of them will still wait until the last minute before actually investing in your raise. You want to make sure that you will convince them. A strong close may mean great news, a great marketing strategy at the very end of your raise, publication, featuring, to make sure that investors will get a good opinion of your company and will want to get on board. Then some of you will probably realize that you will have set up way too early close date. And in that case, you may want to extend your raise, file for an extension, and allow investors to come into your raise after this extension. So let's take a look at whether extensions are actually useful. For companies that raise less than $130,000, these companies are able to get 25% more amount of money, at least for half of them, after they raise. Companies that raise $1.3 million or less by the end of the raise and extended their deal, by at least half of them got 50% more investment post-extension. Finally, for company that raise 1.3 million or more, an extension double the amount of money that they raise for at least half of them. Once you will have closed your deal, you will still need to move with step 10, follow up with investors. Indeed, if you can share quarterly update with investors, how much revenue are you making? Do you have any product launch? What are the success that you're having? Well, investors will feel involved into your company. And they will be more likely not only to invest in your next round, but also share your product and potentially increase your revenue. As you will also be post-raise, you will still have to report to the SEC and to investors through legal documentation the progress of your company. To do that at a lower cost and be compliant with the regulation, you can use raise papers. Finally, as you will have gone through the 10 steps, and you can now picture what can actually crowdfunding mean for you. Know that it can be successful for a wide range of companies, B2B companies, B2C companies, but also companies from different industries. At the end of the day, your goal will matter, and only you can define what success means on a crowdfunding platforms and debt crowdfunding platforms. Thank you.